Intel is scheduled to report quarterly financial results after the stock markets close on July 24th, 2025. Investors are asking me if they should buy the stock before it announces the quarterly financial results. I'll answer that question in this video, as well as preview what investors need to look out for from this semiconductor company in the upcoming earnings release. I'll also share with you my proprietary discounted cash flow valuation model that calculates a fair value for this business. I'll do all of that in this relatively short video, so let's jump into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So in their latest quarterly release, which was published on April 24th, 2025, the new CEO, right? Remember the previous CEO, Pat Gelsinger, was forced out, and they have a new CEO who's been there for less than 1 year now. The CEO said that the first quarter was a step in the right direction, but there are no quick fixes as we work to get back on a path to gaining market share and driving sustainable growth. Gaining market share, I think investors would be happy with Intel if they just stopped losing market share. They've been losing significant market share in the server category as previous generation or legacy data centers that were based on CPUs where Intel dominated are being upgraded and transformed into data centers optimized for artificial intelligence. And those data centers are primarily based on GPUs, and NVIDIA is winning significant market share in that category at the expense of Intel. So that market is booming so significantly that even if Intel was to just stop losing market share, I think it would be a big improvement from Intel as they've struggled mightily in this category. The current macro environment is creating elevated uncertainty across the industry, which is reflected in our outlook, said the CFO. Even before this macroeconomic headwind and geopolitical tension as a result of the tariffs that were implemented or announced in April, Intel was already struggling. And so to add that to the mix just made things even more complicated for Intel. Now, I've spoken so much about their difficulties already, you might think I'm bearish on Intel stock when actually I've had Intel stock rated as a buy all year long in 2025. The reason I've had it rated as a buy is because of the valuation. The stock price had declined so significantly that the present value of the future prospects for the company is now an attractive situation, and that's why I rate it as a buy, even though they face considerable headwinds and they're in a very difficult situation. The company's also undertaking a major cost-cutting regime. In line with their expectations, Intel is reducing their non-GAAP operating expense target to approximately $17 billion in 2025. That's down from the previous target of $17.5 billion. So an additional $1.5 billion in cost cuts in 2025 from an already lower cost plan they were planning. They're also planning further cuts in 2026, dropping it from $17 billion down to $16 billion. Okay, that's one step that you have to take when you realize your business, the revenue, the demand for your products are much lower. You've got to shrink your business to align with the lower demand for your products. Okay, that's just something you have to do, unfortunately, especially if you don't expect any turnaround in the near term. But I think what investors would like more is for the company to find a solution to the market share losses, is for the company to find a product that they can introduce to the market that generates significant demand. So in addition to the operating expense cuts, they're also cutting capital expenditures. They were planning to spend about $20 billion this year on Capex. They lowered that to $18 billion. So roughly 10% decline. Remember, over the previous 5 years, the company has spent massively on capital expenditures, trying to upgrade and expand their manufacturing footprint, trying to upgrade to the latest generation technology from ASML, and also to expand their capability to be able to sell their manufacturing to third parties, not just have manufacturing for their own business needs, but also to have manufacturing available for companies like maybe AMD wants to use their manufacturing, maybe NVIDIA wants to use their manufacturing, maybe other companies want to use their manufacturing facilities. That's what they were hoping, that they can gain contracts from third parties for use of their manufacturing facilities on top of their own internal use needs for their manufacturing. And that has not yet come to fruition. And that's the primary reason why the previous CEO was forced out, is because this was his plan to expand the manufacturing capacity and also enhance the manufacturing technology. And one of the reasoning was that we were going to be able to sell this to third parties who would want to use this local manufacturing, so they wouldn't have to import so much from Taiwan Semiconductor or import so much from companies outside. And given the tariffs, you would have thought that this strategy would be effective. But unfortunately, the product launches have been so ineffective or so inferior that market demand for Intel's manufacturing has yet to come to fruition. So in the first quarter, the company generated 12.7 billion in revenue, which is flat compared to the same quarter last year. But their operating profit margin improved because of all the cost cutting, so that was a good sign. And something I'm looking forward to seeing from Intel when they update investors is progress on their new launch. In February, they launched the new Intel Xeon 6 processors with performance cores, and this is targeted for the data center. Remember, that's the category that's growing significantly, and they're hoping that these processors will gain market share in the modern AI systems. So I want to hear from the company, and I want to hear finally that one of these product launches, because they've had several of these product launches, including the Intel Gaudi GPU, that has been flat. It hasn't come out to very strong demand. And I want to see one of their new products come out to strong demand, something I haven't seen from Intel in several years now. So for the second quarter, they're forecasting revenue of about 11.8 billion at the midpoint, which would be a sequential decline from the previous quarter. So they're not expecting sequential growth from the previous quarter, which is unfortunate because the company could use a boost to their revenue, to be sure. Now, after a long time where the company was generating losses in cash flow from operations, they finally turned positive. In the 3 months that ended March 29th, they generated 800 million in cash flow from operations. That was better than the negative 1.2 billion in the same time last year. And this has been critical because they've been spending so much on their property, plant, and equipment category, which is the manufacturing enhancements and expansions. They spent, even in the most recent 3 months, $5.2 billion compared to 800 million in cash flow. So a huge outflow in free cash flow for the company. And that was even worse in the same quarter last year, where their cash flow from operations were negative and they spent $6 billion. And this has been several consecutive quarters now for a couple of years where their cash flow from operations is nowhere near the level of their additions to property, plant, and equipment or capital expenditures. And so that's leaving the company at a huge deficit while they're trying to build out these manufacturing enhancements that hopefully will pay dividends sometime soon. So all that being said, should you buy this stock before they announce earnings? Well, let me share with you my proprietary DCF calculation for Intel to show you what I think a fair value for this stock is. And the calculation is $32, 31 and 53 cents to be precise, is what I believe a fair value of this stock is today. Current market price is $23. So it still looks undervalued from this perspective, but I will acknowledge this company comes with very high risk, and that risk is elevated now as a result of the geopolitical tension. And then on top of that, there's always elevated risk surrounding a company's earnings release. So you have risk on top of risk here for Intel. To answer the question, should you be buying this stock before earnings? Even though I have the stock rated as a buy, I would not recommend buying it before earnings because of that extra risk you have in a situation that already comes with a lot of risk. I think it would be more prudent in this case to wait until after earnings and then buy the stock. And if the stock price should soar after earnings to the point where it's no longer undervalued and you miss out on this opportunity, so be it. I'm okay missing out on this company. It's in such a difficult situation, so many challenges ahead. I wouldn't feel bad about missing out on this investment at this point in time. So I would rather take the risk of missing out here and waiting until after earnings rather than take the risk of buying before earnings and experiencing a big loss in capital. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.